All right, let's get into it, guys. It's the part-time trader. I know it's been a minute since I dropped a YouTube video for you guys, and I'm sorry that I've been inconsistent as of late, but I am back, hopefully bringing you some useful, valuable analysis today as we take a step back from all the noise in the markets and ask ourselves, where the hell are we at the moment? So I will be looking at the bigger picture in crypto, equities and bonds to try and figure out where we are in the macro market cycle and what that tells us about where price action is likely to head in the weeks and months ahead. If that sounds useful to you, then please do stay tuned. Please smash the subscribe and the like button and help me grow the channel. Casual reminder before we get cracking that none of this constitutes financial advice, but hopefully some of it might be useful, informative, entertaining for you. And if so, please do hit the subscribe button, as I say. We're going to kick off with Bitcoin this week. And I know, look, I've posted this channel. If you follow me on X, it's at Part-Time Charts. If you have been familiar with my work for some time, you will know that I've posted this chart a few times over the last couple of years. And it's not a chart that comes without problems. You know, these log trend lines, these log curves that span all the way back to the inception of Bitcoin are quite popular at times on X. They can unfortunately be bent and manipulated to fit lots of narratives and to present wildly different bearish or bullish views on the future of Bitcoin. But if we're taking a step back, I think they are useful because they tell us a few things about where we are at the moment in the overall market cycle. And the first thing that I would say is I've been talking for a long time about diminishing returns on Bitcoin. You know, Bitcoin has produced absolutely phenomenal gains. It's been the best performing asset of the last couple of decades, possibly of all time, and certainly has produced the kind of life-changing gains for early investors that most of us can only dream of. But when you take a step back and think logically and rationally about where we are in the grand scheme of things for Bitcoin, you can see that unequivocally Bitcoin has been producing diminishing returns for quite some time now. So each of these vertical lines on the chart are a halving. As ardent followers of Bitcoin will know, every 4 years the reward from each new block mined on the Bitcoin blockchain is halved, and that means that the supply of Bitcoin coming into the market reduces over time and creates this sort of deflationary effect as the years roll on. And it's been common wisdom for quite some time that after every halving you would see a really substantial move in the price of Bitcoin to the upside. And you can see that this theory has been pretty strong for quite some time. So in 2012 we had a halving and we had a massive move on Bitcoin in the year that follows from $12 up to about $1,200, So again, a huge 100x move, 10,000% delivered in the space of, let's have a look, a year, almost exactly. So from November 2012, where the halving took place, to November 13, when the market topped out. And then, unsurprisingly, you know, the bubble popped. Bitcoin went through a long, quite tedious correction for investors that caught the top of this, but eventually started to resume its uptrend. And in 2016, you had a halving that then went on to produce 30x gains over the year that followed. And then again, the pattern repeats, where the bubble popped, a long consolidation ensued after a big correction. And then in May 2020, you had a halving that preceded a 600% shift to the upside. But what's happened recently, and this is why those of you who have been following me for quite some time will know that I am bearish on Bitcoin here. I think at the very least, if you're bullish on Bitcoin, now is the time to be cautious and to be sensible about where we are in the overall market cycle. Because as you can see, this log curve has been flattening out over time. And with each market cycle, with each 4-year cycle, with each halving, you are starting to see a decline in the upside that Bitcoin is producing for investors. So if you were somebody that bought in the first halving in 2012, you saw a whopping 100x return in the year that followed. But if you were to have done the same thing in the halving that took place in April 2024, a year and a bit later, almost a year and a half later, and you will have only realized a gain of about 100%. So I say only, I realize that 100% in a year is a pretty significant gain. But when you look at what some of the major tech stocks have done over the last year, you know, this kind of gain is for most people not life-changing. It's not phenomenal, and it certainly isn't the kind of gain that most crypto enthusiasts get into this very risky, very volatile market for. Let's be honest, we are all here because we want to see the kind of 20, 30, 40, 50, dare I say it, 100x gains that crypto has been able to produce in the past. And the reason that I say that now is a strange time to be bullish is because the halving was close to a year and a half ago now. And in that time, which is the period in which Bitcoin normally sees its steepest ascent, we have seen a move of 100%. And that, for me, confirms this pattern that we see of diminishing returns, where we've gone from delivering 100x returns in the year that followed the first halving to 100% in the year that follows the most recent halving. So for me, I am struggling to be macro bullish on Bitcoin and crypto here, because it looks like a year and a half on from the halving, we are struggling to get the kind of momentum behind us that we have seen in previous cycles. So that's the first point. And the second point, if we're taking a step back and we're looking at markets, I know it's not popular to look at bond markets and to look at yields because everybody's obsessed with crypto and altcoins and the kind of life-changing gains that we're all pursuing in that market. But look, crypto does not exist in a bubble. Bitcoin certainly does not exist outside of the macro financial landscape. And what we're seeing with bond yields at the moment, particularly in Europe, and this is the 30-year German yield, but you can see a similar story on UK gilts at the moment. To some extent, even the US is mirroring this trend. We are seeing rates are remaining stubborn, and particularly at the long end of the curve, we are seeing rates rise, not fall. And you'll notice that Trump has been coming out in recent weeks criticizing the Fed and saying that he wants rates lower. I think markets are in a really tricky place. Policymakers know that if rates push higher, it's going to make the job of governments way more difficult than any politician, leader has had to face in the last 40 years. Because look at what rates have done since the late 80s. They have largely been on the decline, and they've supported, lower rates have supported this huge debt bubble that we've created. And that is not just about consumer debt, corporate debt, that is also about government debt. And as these rates push higher and governments have to refinance the huge amounts of money that they have borrowed from markets over the last 40 years, they're going to struggle to do that if these rates continue to push higher. So the reason I highlight this is because if you are wondering where we are in the grand scheme of things, my personal view is that we are at the end of a massive 40-year debt cycle that has seen just gluttonous levels of debt brought into the public domain by governments who have not been able to curb their own spending and to create sustainable sort of budgets to fund ultimately public services. And this is the case in Europe, it's the case in the UK, it's the case in the US. And we're also seeing really significant challenges with bond yields in Asia too. And you can see this is the TLT. So this is a treasury bond, a US treasury bond ETF. This is the inverse of the problem that we've got with rates, is that as rates push higher, the price of bonds press lower. And it looks to me as if treasury bonds in the States are literally at what I'm calling here the gates of hell. We have broken down from this huge macro uptrend dating all the way back to the early 2000s. And when this kind of long-term trend breaks, it's highly unlikely that we see a resumption of the trend anytime soon. You have to ask yourself, guys, if rates have been on the decline for 40 years, is it likely that we're going to get one push to the upside, break this massive downtrend that we've seen in rates and yields over the last 40 years, and then all of a sudden these yields are just going to collapse back to the lows and make everybody happy with cheaper debt? I just cannot see it. And if you look at, I mean, you can't get a clearer picture than this. This is US 30-year government yields, and yes, German yields have started to put in new highs, and US yields are not quite there yet on the 30-year, but they are still stubborn, and we're seeing what looks to me like a period of consolidation before yields press even higher. And think about the reality that dynamic is going to create in the market, because if you're my age, if you were born in the 80s or the 90s, you're really going to struggle with the idea that rates are going to be up in double digits. But I believe that's what the chart is telling us, right? And if you speak to anybody who was around back in the 70s, they will remind you that there was a period of stubborn inflation where rates in the UK, for example, were up at 15-16%. And what that did was put massive pressure on the consumer. People were struggling to refinance their debt, to refinance their homes, to take out mortgages. It put huge pressure on governments who unfortunately had to allocate a bigger proportion of their overall revenues to simply financing the debt, to paying interest payments on the debt that had accumulated and built up over decades. And we're seeing, in my view, a similar situation to the 70s, where inflation is starting to rear its head again, and some of these rates just do not look like they're coming down. And when I look at this and I see a break of a 40-year downtrend and a consolidation above that downtrend, to me, this does not look good. If you're an equity or a crypto investor, I'm not saying that prices cannot go up next week, next month, even next quarter. But what I am saying is that this is a major warning sign that trouble is brewing in the market. And the sort of 20% downswing that we saw in the Nasdaq earlier this year may look like a really minor pullback in the rearview mirror when all of this is said and done. So look, I'm not saying that you have to believe that this marks a market top, but I am saying that you would be silly to ignore what's happening in bonds, where prices are consistently pushing lower and are consolidating at these lows and retesting these lows consistently, and what's happening in yields, where rates are just pushing higher, are consolidating in a really stubborn fashion up here and look like they're going to burst to the upside. And if that happens, how likely is it that equities and crypto are just going to continue to boom? That is not consistent with what we saw when inflation picked up in 2022 and we got a major correction in equities and crypto. And I believe that will look like child's play relative to what is about to happen if these rates continue to push higher. And here's the yield curve. So, we've looked at rates, we've looked at the bond market. To me, it looks like bonds are on the verge of an absolute collapse, that governments and individuals are going to struggle to refinance the huge amounts of debt that have been taken on over the last 40 years in this massive debt bubble. And that debt bubble has obviously fueled some of the massive appreciation that we've seen in risk on assets like equities and like cryptocurrencies, where rates have been artificially low and people have really been throwing money at markets for a long time. And the kind of inflation that comes with the debt bubble that we've seen has driven the price of equities to huge highs. And I'll come on to place that into context for you in a second. But the other big warning sign for me is the yield curve. And I'm not going to dwell on this for too long because I've covered this in previous videos, but this is the yield curve. And when we see periods where the yield curve is inverted, and you can go back to some of my previous videos for a more detailed explanation of what that actually means. But just very briefly, when the yield curve is inverted, that is normally a sign that there is trouble brewing in markets, and it's not very good at predicting the exact time of market tops, but each of these horizontal red lines represents a major significant top in the stock markets. And this is particularly these red lines pinpoint the top of the S&P 500, the main sort of global index, which we use as a barometer for health in the equity markets. And you can see here that after we saw periods of yield curve inversion, we have seen in subsequent months the market has topped out, and some of these have led to really, really painful corrections for investors. So the crash that we saw when the bond market imploded in 1990, the end of the dot-com boom in the year 2000, where the S&P and the Nasdaq topped out and had a really, really significant decline, and of course the great financial crisis of 07-08, which for most people of our generation, that would have been the first time that we really paid attention to a significant downturn in the stock market. So I suppose what I'm saying here is, if you're looking for reasons to be cautious on equities, there is a massive one here, and that is the deepest and longest period of yield curve inversion in history. This chart only goes back to the 80s, but you can go back all the way back to the Great Depression, and we have never seen a period of yield curve inversion of the kind of scale of this. And yes, as the yield curve has disinverted, equities have continued to push higher, and we saw much the same in 07-08. But the question for me is that sustainable? How long before equity markets snap back and get pulled back to reality? Because this, and I won't get into all the detail as to why here, you can go and check out my previous videos, but this is a massive, massive red flag over equity markets in my view. And of course, timing is the big challenge. But if we're just focused on the bigger picture, if we're just trying to work out where are we in the grand scheme of things, I would say that there are plenty of reasons to believe that crypto and equities are coming into a major period of risk where, unfortunately, I would say risk reward is skewed in favor of the bears here. Because if you are getting bullish on Bitcoin up here, a year and a half on from the last halving, where price action, let's be totally honest, has been lackluster compared to previous cycles, then I'm afraid, I hate to tell you this, but I am afraid that you are probably quite late to the market. Bitcoin is trading up at a whopping 110,000, 108,000. We have seen an unbelievable decade of performance from Bitcoin. But if you're bullish up here and you're throwing money at the market blindly, then I worry that you may be disappointed. And I think bonds, yields, and the price of bonds and the yield curve all point to the fact that there is major systemic risk built up in the market. And here's another interesting chart that I wanted to chuck up today. And this is the Shiller PE ratio. I have borrowed this from someone on X. I can't quite remember who, but I downloaded this the other day. And if it's your account that I've taken this from, then apologies. And I'm happy to drop you a credit if you leave a comment below this video. But this ultimately is a really simple chart that takes the Shiller PE ratio, which is essentially a proxy for how over or underbought the market is at any one time relative to earnings of some of the top companies in the US. And what you can see here is historically, if the mean is down here in the sort of 15 to 25 region, historically we are massively elevated at 39. And this chart goes all the way back to the late 1800s. And you can see there's only been one period in all of history where the stock market has been overvalued relative to where we are now. And that was in the year 2000, when we saw this huge boom in tech stocks and what was later branded the dot-com bubble burst before a major correction in both the Nasdaq and the S&P. I mean, even going back as far as the Great Depression, at the end of the roaring 20s, the roaring 1920s, the valuations then were pretty tame compared to what we see now. So I suppose, again, taking a step back from the market, ignoring price action, ignoring the daily, the weekly, the monthly charts for just a second, where are we in the grand scheme of things? Now, does this mean the market has topped? Absolutely not. Could the market press higher from where we are? Of course it could. And, I was somebody who a year ago, I say a year ago, probably 8 or 9 months ago, back at the end of 2024, I was calling the top on the market. And of course, prices bounced around since then, both in equities and in crypto. And price has been stubborn and hasn't yet produced the kind of precipitous drop that I've been forecasting for quite some time. But ignore all of that. Ignore the short-term price fluctuations. Just ask yourself, is the market under or overvalued right now? And if you are looking at this on a historical basis, you have to say the market is massively overvalued versus earnings of the top companies in America. And you can see that in this chart here. So this chart is fascinating because this blue line here is the stock market capitalization to GDP for the United States. So this blue line is the capitalization of all of the stocks in the United States, the entire stock market, relative to GDP for the United States. And you can see that where we are now, we are up. I think this is probably annoyingly just outside of the screen capture that I've got set up, but we are currently at just under 200% stock market capitalization to GDP. So that means that the US stock market is 2 times the size of American GDP. And that dwarfs any position we have been in historically. I mean, you can go back to 2017 and we were at 164%. We were at 150% in 2014. And interestingly, if you look at some of these massive peaks that came before that, what did these precede? So this huge peak in 1989, where we were at 140% stock market capitalization to GDP, happened a year before we see the collapse in stock and bond markets in the year 1990. And this here happened in 1999, where we got to 150% stock market capitalization to GDP. Again, a year before we saw the collapse of the dot-com boom and the huge pain that was created for investors in the years that followed, particularly for investors who bought into tech stocks and the hype that came with the dot-com bubble. And this, which is another major peak, took place in the year or two before we saw the great financial crisis. So historically, what happens is that price is driven, the price of stocks in the US is driven to places of unsustainable ratios versus GDP, and then we see major corrections in the price of those equities. And interestingly, this peak here puts us at historic levels, and also you can see this complete decoupling of US stocks versus the rest of the world. Decoupling is probably the wrong word. There is still a trend that exists between them, but the relative valuations of a US stock market relative to US GDP is massive compared to other markets like Japan, China, and the Eurozone, for example. So again, this doesn't necessarily predict that the market is topping out here. And certainly when we've hit major peaks in the late 90s and in the mid 2000s, it has taken a while before you would see a rolling over of the equity market and a complete collapse in prices. But where we are right now, if the point of this video is to basically take a step back and assess where we are, this tells me that we're not in a great spot right now. And if you're a value investor, if you're looking to invest for the long term, this might be the time to put your credit card back in your pocket and keep your money safe for a little while. Let's take a look at what the charts are telling us about equities. Given everything I've just told you about bond yields, about the position of the crypto market, it's unsurprising that I am still predicting a major collapse in the value of the Nasdaq. And yes, I know people will point out that I was bearish at the end of 2024, and I absolutely was. And you'll remember the early 2025, I called the absolute top here before we got this big 20% collapse. And yeah, since then, it looks as though I've been premature on my bearish view. But in the grand scheme of things, if I'm right, and if we are at a point in the cycle where we are likely to see a major correction for equities, then in the rearview mirror, this push, 10%, 5% above the previous high is going to look so insignificant that this bounce, I know, lots of bulls are really excited. But guys, if you're following people that are blindly telling you that this is the start of a massive bull market and the equities and crypto are just going to rise exponentially from here, then I would question whether you're following the right people, because all of the charts that I've just showed you, whether that's stock market to GDP for the US, whether that's the Shiller ratio, whether that's the big breakout that we've seen in bond yields, all of these point to really fundamental challenges for equity markets at a point when these equities are massively overvalued relative to historical averages. So for me, you can do all the mental acrobatics you want to convince yourself that you're early to equities, but you're not. You are buying, if you're buying here, in my view, you are buying the tail end of a massive bubble that has built up over the last couple of decades. And this chart makes that plain for me. We've seen the Nasdaq bouncing off this uptrend all the way back to 2010. 15 years of price bouncing off this uptrend every time we've come to hit it. Last time we hit it was in late 22, early 23. But eventually, this type of pattern, in my view, is very likely to collapse to the downside when this trend line gets breached. And the more times we hit it, the more likely it is that the next bounce from that trend line will be weaker or non-existent, and that price will go through a serious correction. And you can see that we got a much steeper rise. Market capitalization was much smaller. The market was much more immature in the tech stock world, but we saw this really steep rise in the late 1990s into the year 2000. And ultimately what followed was a really painful collapse. And I am projecting that we're likely to see something else. Now, that doesn't mean that we necessarily top out right here. Could we push up a bit further? Of course we could. But you have to ask yourself how much juice is left in this market, given the kind of PE ratios that we're experiencing. Investors are massively overpaying for every pound of earnings, every dollar of earnings right now. And I think it's only a matter of time before that translates into weaker demand for stocks, particularly if rates push higher and financial markets come under severe pressure globally, as I'm predicting. So that's my view on equities. And unsurprisingly, if you followed me for a while, you'll know this is what I'm projecting for Bitcoin. The charts are pointing to this as a huge area of resistance, and I think we're seeing that play out now. We've spent a good 2 to 3 months lingering in this sort of like 100 to 100k region, to 120k region for Bitcoin. And it reminds me a little bit of the price action that we saw back here in the spring of 2021. I do expect us to make one push higher to the upside, and I'll come on to why in a moment. But I do believe that early shorters are going to get blown apart, and that Bitcoin will push back up into the $120,000, $130,000 region, possibly even as high as 135 to 140k. But when that is said and done, I believe we are going to see a correction that nobody in the world of crypto is anticipating, and that ultimately we will get an opportunity to buy Bitcoin at the kind of prices we haven't seen for about 7 or 8 years since 2018. And look, people can argue, you can debate with me about whether I'm too bearish, whether this price target is unrealistic. But we've seen really significant crashes in recent years. You go back to 2021, we saw a 77% correction in the price of Bitcoin, and equity markets at the time, I think the Nasdaq was down about 30% from high to low. So what happens if the Nasdaq is down 60, 70% over the next couple of years? Bitcoin is going to get absolutely hammered. And if you believe that Bitcoin is immune to significant turbulence in the stock market, then I don't know what to tell you, because all the history, all the price action that we've seen historically points to the complete opposite. Ultimately, I still believe that Bitcoin is highly correlated with the Nasdaq and with top tech stocks, and when they roll over, Bitcoin is going to do the same. And lots of people are still calling for alt season. I have said for a long time that we will only get a kind of huge period of appreciation for altcoins if ETH-BTC breaks this downtrend. And so far, despite all the excitement on X, ETH-BTC is being rejected off of this downtrend. And so I can only see two paths from here. One would be a break of this downtrend, and if we start to hold on the weekly, I think that's a sign that the market is going to come back up and take out these highs here at about 0.086, which means that Ethereum is probably going to 10 to 15k in that scenario. The other option, the other scenario would be that we continue to see ETH-BTC rejected here, and I think that could happen in a period of strength for BTC. So if over the next couple of months we see BTC push back up to the highs and maybe put in a new all-time high before wicking down on the monthly and creating the kind of conditions for a major collapse to the downside, if BTC shows significant strength, then I think it's likely that ETH-BTC will continue to get rejected here, and we could see more consolidation on ETH-BTC back to these lows before finally bottoming in 2027. But look, despite my pessimism, I still think there's money to be made. So I do think we are getting closer and closer to a macro top in equity markets. I do think that there are major warning signs in bond markets, in yields. I think there are signs that the market is massively overvalued in historical terms, both in terms of the amount that you are paying for earnings across top US stocks, and also in the US in particular, the relative price of the stock market to GDP for the United States looks insanely overvalued. And I believe that we will see a major collapse in BTC, in ETH and the Nasdaq starting before the end of the year. But as the market is in its final throes, we could definitely see some major gains to be had if you're on the right side of the right trade. And one of the trades that I like the most is Riot Platforms, which is a BTC miner. And I fluctuated a bit on this. We got a false breakout last month and it made me wobble. But now it looks as though we've come back up to retest this downtrend again. And on the daily, we're starting to hold above it. And I believe that after 2 years of consolidation while Bitcoin has been booming to the upside, I believe that we are in a position where a breakout is imminent. And this for me is a catch-up play. So if you're somebody who has missed some of the upside on Bitcoin and wants to try and profit from the final throes of this historic bull market, this bubble that has seen the price of Bitcoin driven to 120,000, this to me looks like a really interesting play, because if we were to revisit this major trend line here, you're talking about a 7 to 8x move, possibly even a little bit more if we get a wick into this $130, $140 region on an asset that is currently trading for $13. And I know people will think this chart is a little bit ludicrous. People don't like it when I make these predictions for rapid price increases like this. But look at the history of price action on Riot, right? So when we got this breakout, this key trend line here was broken in late 2017. And it was 3 or 4 months for the price to go from $4 to $47. We saw a similar thing in late 2020, where again, it was about 4 months for price to go from $2.50 up into the $80 region. And so in my mind, it's not out of the realms of possibility at all that we break this downtrend at about $13, $14, and we could see something like a 10x move over the next 3 to 4 months. And personally, I think the consolidation that we're seeing here, this pattern in particular, gives me huge reason to be bullish on Riot. But there are other signs too. This is Riot versus gold, and it's a similar pattern, but the price action is even cleaner. Riot looks like it is about to have a period of outstanding performance relative to gold. And you all know how bullish I am on gold over the long term, but this looks like an incredible chart. And so while I'm bearish, I'm also strategically placing capital in some of these assets where I just think the charts are too good to miss, too good to ignore. And I am definitely not somebody who is blind to upside opportunity as the market puts in the kind of final leg of this historic bubble. And Doge is another one of the charts that I like for similar reasons. I can see us, as I've posted on X many times before, we've broken this downtrend that dates all the way back to the turn of the year, the turn of 2024. I think this is probably a macro bearish pattern, but there is still, having broken this downtrend, I think there is still reason to believe that Doge is always a late bloomer. And normally what happens is Bitcoin and Ethereum top out before Doge go on a massive run. And I think we could be seeing something similar where where BTC and ETH are consolidating at their highs and are likely to roll over in the coming months. But that might give us enough time, the next sort of 6 to 8 weeks, for Doge to run massively. And ultimately, my targets would be the previous high at about 80 cents and potentially even as high as sort of $1.2, $1.3 before I believe price totally collapses and goes much lower than most people can even fathom. But not everything in the altcoin market is going to perform that well. I think that we are in the final throes for a few of these major projects, and this is BNB. And I'm sorry, I know lots of people will disagree with me, but I just do not like this chart at all. This looks like, reminds me a little bit, if you've seen any of my Solana versus ETH charts, we had this big period. Let me just pull that up. We had this big period of consolidation around about the previous high, and everybody was excited. They felt as though we had flipped this previous high into support, and I could see why. But to me, it looked like we were painting this sort of big rising wedge, which ultimately was going to be bearish. And what has happened since? I was calling for a high back here in May, and you can see that the price of Solana relative to ETH has pretty much collapsed since then. And it's my view that we are seeing something similar play out in the price of BNB versus the US dollar. And so yes, I have been calling for a little while now for one last push to the upside, and I don't think we're done. I think we're going to come up into about the $1,000 region and get a bit of an overthrow, which people will get excited about, but then I believe price will collapse back in under this upper boundary of this rising wedge, and then that will mark a massive, massive top. And in hindsight, all of this will look like a massive period of distribution, some sort of wick-off distribution range where you get a big fake out to the upside, and the collapse back under points to much, much lower prices. And I know people think I'm crazy, but I think there are some real skeletons in the crypto closet. And I think, some of these exchanges, we've seen in the past, trusting in these centralized exchanges, these centralized projects, doesn't always work out. And I don't know anything particular about BNB, but all I know is this chart points to much, much lower prices. And would it massively surprise me if this collapsed and some awful news came out about Binance as an exchange? I'm not saying that I know anything about the company or its position, but we've seen this kind of price action in the past. We've seen some of these centralized projects that everybody has trusted and seemed to be market leaders have surprised people, and nothing would surprise me in the crypto market right now. And again, XRP is another one where I believe we're at the tail end of distribution. Could we get one more press up into the sort of $4 to $4.50 range? Of course we could, but on a macro scale, I think all of this is just distribution, and at the very least we come back into these range lows. Potentially we see a total collapse in some of these assets in the years to come. Now, I'm going to record this on YouTube and Twitter, or X for posterity. I suspect people will be calling me crazy for the next couple of months, but I have a strong gut feeling that in a couple of years' time, some of these charts will make me look like a prophet. And again, just a bit more context on where we are. People are calling for alt season, but Solana, which has been the market leader for much of the last couple of years, put in this huge distribution and is now backtesting that distribution range, the underside of that distribution range on the Solana BTC pair. So again, if the market's really bullish, if altcoins are really about to go to the moon, I just think at the very least we have to reclaim this key weekly level first. Otherwise, I think we're going to see a period of distribution here before the next leg down on Solana Bitcoin. Ultimately, I'm targeting this region here somewhere in the year 2027. So look, that is my step back from markets. Bigger picture, not the time to be bullish for me. Very clear that Bitcoin is no longer producing the kind of gains that we love. And for that reason alone, a year and a half out from the last halving, I think there are warning signals flashing that this one is running out of steam and that we're going to see some downside. I believe that yields and bonds are telling us to get out of equity markets, to get out of crypto. And I'm sorry to say, but if you're buying equities when the US stock market is valued at close to 200% of GDP for the United States, then if you think that's value investing, I don't know what to tell you. And I know this sounds pessimistic. If you want to know how I'm allocating my own capital, I believe that gold and oil and other precious metals, other commodities will perform really well over the next couple of years. And you can go back and look at some of my other videos to get a bit more detail on that. But put simply, now is not the time for me to be turning bullish on equities or crypto. Some tactical trades on some charts that look really, really good over the very short term, and I'm talking, from now until the end of the year max, is where I'll be focusing my efforts in those markets. But otherwise, I'm out and I'm waiting for real bargains to present themselves in the next couple of years. Look, I will stop rambling on and I will leave you with this chart. Just a quick one to say a massive thank you for all the support that you guys have shown me. I do really appreciate it. And if you could continue to subscribe, to like, to share my content, I would massively appreciate it. Enjoy the rest of your weekend.